So here we look at what are the accounting conventions. So these are the accounting conventions. The first one is convention of consistency, convention of full disclosure, convention of materiality, and convention of conservatism. So if we will look at from convention of consistency, the consistency convention implies that the accounting policies must be followed consistently from one accounting period to another. So in accounts, there are like many options which are available. For example, you can use FIFO method or average method for valuing inventory. You can use a higher provision or a lower provision for your depreciation, or you can use straight line method or written down value method, like that. Okay, so you can use like different methods in different places. So what happens is, if a company uses like different methods for each and every year, then it's like very difficult to compare. Okay, so companies and businesses are expected to follow the same accounting rules every year. So if they are going to follow straight line method, it's going to be straight line method for a number of years. If they are using a 5% provision for debtors, it should be 5% provision for debtors for a lot of years. Okay, so if they're using like FIFO method for valuing inventory, it should be FIFO method for valuing inventory for a number of years. Okay, so then only like the year to year balance sheet and P&L can be compared. Okay, so that is what is consistency concept is about. The results of different years will be comparable only when the same accounting policies are followed from year to year. For example, if a firm follows straight line method of charging depreciation since its purchase or construction, the method should be followed without any change. Change in accounting policy can be incorporated in the following circumstances to comply with the provision of law. So you can change a particular policy only when the law requires it, or the accounting standard has been issued like that, or if the business feels the change to a new policy will be like fairly representing the business. Okay, that is the correct method of depreciation, or that is the correct method of provision. Okay, if the business feels that is the correct method, then they can change. Okay, so uh, these these rules ensure that businesses keep on don't changing their policy every year. Okay, so that's about the consistency policy here. The next one is full disclosure. It implies that the accounts must be prepared honestly and all material information should be disclosed in the accounting statement. This is important because the management is different from the owners in most of the organization. See, the equity shareholders do not get anything from the company apart from the financial reports. Okay, apart from the financial statements, the shareholders are not going to get anything from the company. They cannot go directly to the company and manage. They cannot say, I am the shareholder, so I will sit in the board of directors meeting. He can't say anything there. So the only mechanism through which he can find out whether the company is operating properly or not is the financial reports. Okay, so at least that financial reports should fully tell like what the business is doing. The disclosure should be full, fair, adequate, so that the users of the financial statements can make correct assessment about the financial position and the performance of the business unit. So that's about the convention of full disclosure. So the next one is convention of materiality. So according to this convention, financial statements should disclose all material items which might influence the decisions of the users of financial statements. So the concept here says is materiality means important. Okay, so a business doesn't need to tell all insignificant matters. Okay, they have to tell only the significant matters which will uh, affect the shareholders decision. Okay, so don't keep on telling like small petty expenses, okay, petty incomes and all. We don't need to tell. We have to tell major things based upon which the user will take some decisions. The principle is basically an exception to the full disclosure principle. So a company has to fully disclosure, but only the material things they have to disclose. Okay, so that's about the convention of materiality. The materiality is subjective in nature. Okay, So what is material is very subjective. Materiality depends on the amount involved in the transaction, the size of the business, nature of the information, requirements of the person making a decision. Okay, so usually accounting statements are prepared for the benefit of shareholders only. Okay, so they are not prepared for the benefit of government or for the benefit of financiers or employees. So what is material here is what is like important things that the shareholder considers are only shown here, not what is important which is considered by the tax authorities or the employee is like shown here. Okay, so that's about materiality concept here. The next one is convention of conservatism or prudence. It is a policy of caution or playing safe. While recording the business transactions, one has to anticipate no income but provide for all possible losses. Okay, so for example, you can say that you have the concept of provision for bad debits. Okay, you foresee some kind of a you foresee some kind of a loss, right? For provision for provision for bad debits, you foresee some kind of a loss. So you now itself you are trying to create some kind of a provision. Okay, that is very conservative. Okay, but can you create a provision for future income? Okay, can you create something like that? The answer is no, because prudence says that you can anticipate no income, but you have to provide for all possible losses. Okay, so you can't say that my next year anticipated income is like this. Shall I show it in sales? Means no, you can't show it in sales of this year. But you can say that next year I think I will incur a loss in terms of receivables. So shall I show it in this year? The answer is yes. For example, the closing stock in the factory is valued at 35,000 at cost and 25,000 at its realizable price. So you have bought it at 35,000, but if you sell it today in the market, it's only 25,000. So at what value will you show it? You have to show it at the lower value, 25,000. The reason is you have to be very prudent or conservative. Okay, you have to should be very prudent or conservative. So you have to show it at the 25,000 only. 35,000 is too optimistic. Okay, you have to be little bit pessimistic. According to realization concept, any increase in value is not to be accounted unless it has materialized. So you cannot expect any uh, future sales, you cannot book it in this year. Okay, so that is like impossible. The conservative convention puts further restrictions on it. Any unrealized gain is not to be anticipated, but provisions can be made against all possible losses. Okay, so that's about the convention of conservatism or prudence. So now we will see as a last slide the need for accounting standard. Why should we have an accounting standard? Okay, see, accounting standards are issued across many countries. Okay, so every country gives its own uh, accounting standards. For example, so if you see here, accounting standards in India or accounting standards, we'll just check for around the world. So how many accounting standards are in the world? Okay, so that we can't say. So Wikipedia has element here, though. So they tell about accounting standards. So look at here. These are the accounting standards which are like adopted by each country. See, every country or every major developed country will have their own accounting standards. See, for Canada, China, France, India, okay, even Nepal has its own. Russia, Sweden, Switzerland, UK, and US. Okay, usually smaller countries will not have their own accounting standards. They cannot like have their own accounting standards because preparing accounting standards is like very tough. Okay, but why do some countries have accounting standards? See, accounting standards are there to ensure all the accounts prepared in that country are of similar nature. Okay, so once they are very similar, it's easier to compare, understand, and do things. Okay, or analyze. So the benefit is to promote better understanding of financial statements, to help accountants to follow uniform procedures and practice, to facilitate meaningful comparison of financial statements of two or more entities, to enhance reliability of financial statements, to meet the legal requirements effectively. Okay, so if you have so every country has its own accounting standards based upon which the accounts have to be prepared. Okay, but the problem is every country has its own. Okay, every country has its own accounting rules and regulations. Okay, so India has its one. Okay, throughout the world, what has happened is all the countries are like converging towards IFRS. Okay, International Financial Reporting Standards. Okay, so they are like converging here. So the converging actually works like this. So let's see. See, IFRS IFRS standards are required in more than 140 jurisdictions. Okay, so many companies have allowed IFRS to be used. Okay, so these are the countries from South Korea, European Union, India, Hong Kong, Malaysia. Okay, all these countries have accepted to use IFRS standards, and some countries have like totally uh, fully 100% they have taken. Some countries are like slowly adopting towards IFRS, so they are not like exactly. See, IFRS is a separate accounting standard, okay, which is created by a separate organization called as IFRS. Okay, so throughout the world they are slowly, every country is converging towards the IFRS standards here. Okay, so learning IFRS is like very useful if you are going to be in accounting kind of a domain. So that's about the concept here. So we'll end the class now.